Welcome to Multibagger Shares. I'm Manish Goel, SEBI registered research analyst. And today we're diving deep into one of the most dangerous cognitive biases in investing. Anchoring bias. What is anchoring bias? It's the tendency to rely too heavily on the first piece of information you encounter when making decisions. In the stock market, this anchor can be your purchase price, a 52-week high, an analyst target, or even a round number on the Sensex. Today, the Indian market surged powerfully. The Sensex closed at 77,562, up nearly 4%, and the Nifty closed at 23,997, up 3.78%. This massive rally was driven by the US-Iran ceasefire and the RBI's decision to hold rates. On a day like this, anchoring bias is everywhere. Some investors think the market has run up too much because they're anchored to last week's lower prices. Others think there's still room because they're anchored to even higher levels. Both are making decisions based on irrelevant reference points. Let's talk about the 5 deadly anchoring traps that destroy Indian investors' wealth. Trap number 1. The purchase price anchor. When you buy a stock at 500 rupees, that 500 becomes your emotional benchmark. If it drops to 350, you hold because selling would lock in a loss. If it rises to 600, you sell to book profits even if the business is worth 1200. Your purchase price has zero bearing on the stock's future value. The market doesn't know or care what you paid. Consider Titan Biotech, currently trading at 478 rupees with a market cap of 1,976 crore. An investor anchored to the pre-split price might think it's cheap. Another anchored to the 52-week low of 75 rupees might think it's expensive. Both are wrong. What matters is the business quality. ROAS of 16.9%, ROE of 15%, and a debt-free balance sheet. Trap number 2. The 52-week high-low anchor. Financial media constantly flashes stock near 52-week high or stock at 52-week low alerts. These create powerful anchors. A stock at its 52-week high feels expensive. A stock at its 52-week low feels cheap. But these are arbitrary time-based reference points that tell you nothing about intrinsic value. Trap number 3. The analyst target price anchor. When a brokerage sets a target of 700 on a stock at 500, that 700 becomes your anchor. You sell at 700 even if fundamentals justify 1000. Analyst targets are just estimates with wide error margins. Never anchor your decisions to them. Trap number 4. The round number anchor. Sensex 80,000. Nifty 25,000. These round numbers become massive psychological anchors. With Nifty at 23,997 today, thousands of traders have orders anchored to 24,000. Round numbers are psychological traps, not fundamental benchmarks. Trap number 5. The what I was told anchor. When someone tells you buy XYZ at 200 it will go to 500. You're now anchored to both numbers. Your entire analysis framework has been hijacked by someone else's arbitrary numbers. So how do you defeat anchoring bias? Here are 5 strategies from our 95-factor fundamental analysis framework. Strategy 1. Always think in terms of intrinsic value. Never price history. The only question that matters is, what is this business worth based on its future earning power? Strategy 2. Write down your investment thesis before you buy. Your sell criteria must be based on business fundamentals, not price levels. Strategy 3. Use the fresh eyes test every quarter. Ask yourself, if I didn't own this stock, would I buy it at today's price based on today's fundamentals? Strategy 4. Focus on business metrics, not stock price metrics. Revenue growth, operating margins, return on capital, cash flow consistency. These are what matter. Strategy 5. Embrace concentrated conviction investing. As Warren Buffett says, wide diversification is only required when investors do not understand what they are doing. When you concentrate your portfolio in 5 to 10 deeply researched ideas, you understand each business so well that no price anchor can shake your conviction. Remember, SEBI data shows 9 out of 10 individual traders in the F&O segment lose money. Many of these losses stem from anchoring bias. Stop gambling in F&O. Focus on quality stock picking and long-term value investing. If you want to learn more, check out our free value investing course on this channel. Subscribe, hit the bell icon, and join our Telegram channel at Long Term Equity Y for daily value investing insights. This is Manish Goel from Multibagger Shares. Happy investing. Disclaimer: the author Manish Goel is a SEBI registered research analyst. Registration number INH 100004775. And Multibagger Shares is a SEBI registered investment advisor. Registration number INA 100007736. This video is for educational purposes only. Please do your own research before making investment decisions.